Hi everybody, welcome along to our webinar today, SMSFs post the federal budget. I'm joined today by Jenna Teely. Thanks for joining me today, Jenna.
Nice to be here, Tim.
So look, we've got a bit to get through over the next hour, and while some of it is sort of speculative, there's a number of things that I want to be able to address with people, and you know, thankfully or not so thankfully, depending on how you look at it, but I was actually involved with sort of a roundtable discussion with Treasury around the better targeted super concessions. I'm not sure if the title is the appropriate title, but I've been involved in that round table discussion, so it's good to be able to give you some sort of genuine feedback from where Treasury are at with that measure. So well, let's jump straight into it. Obviously, our disclaimer, based on how and where we're at with the world. This is everything as we know it as of a couple of days ago, where I finalised the presentation. But what we want to talk about today, and what we're going to work through, is the key federal budget announcements as they sort of impact self-managed super fund. And to be honest, there wasn't that many, Janet. It was relatively quiet, but those that there were, those announcements that occurred were relatively significant for our industry moving forward. So it's good for us to be able to work through that. The considerations in Australian superannuation fund. So again, when we're talking about measures, we also need to talk about those measures that didn't occur.
Exactly.
And what that impact is for self-managed superannuation funds. Indexation, we get our usual 1 July indexation of a number of factors, so I'll touch on those as well. But also, I will look through some of the other budget measures that weren't, or non-budget measures, should I say, that weren't visited in the budget, and what that actually might mean for us as well. And the elephant in the room. So, what am I talking about when I'm talking about the elephant in the room? Well, we might as well start off with that and then sort of progress our way through the announcement. So what we know is that we had the budget announcement, and the biggest announcement for self-managed super funds wasn't actually made in the budget. It was made in February, and that was this better targeted superannuation concessions. And for those that have watched and listened and read enough federal budgets over the years, you know that the government tried to, as much as possible, make budget night about good news measures. Now, in this instance, the $3 million superannuation threshold and the appropriate tax linked to it, whether or not that's a good or a bad measure is going to be subject to people's own opinions there. But the other thing is, the government basically needed to put out a bit of a fire, because there was talk around the SMSF Association when the Treasurer came and spoke about superannuation, or the Minister came and spoke about it. There was conversations around $5 million caps, all sorts of things. So the government ultimately released this measure early to put out the fire before the federal budget. So we ultimately knew what was coming, but we didn't know whether anything else was coming. And a lot of that was driven by this concept of the objective of super. So what I wanted to touch on first is really just a bit of an overview about this objective of super, and then we'll get into a bit of a discussion together about the federal budget measures themselves. So in January, the government did announce their intention to legislate an objective of superannuation. Now, this isn't new. So in 2000, it stems all the way back almost 10 years now, but in the 2016 super reform, the government of the day drafted legislation. It was pretty much a simple one-liner to draft the legislation, which was the objective of superannuation bill. That lapsed in 2019, and the new government have ultimately taken it upon themselves to say, right, we need to further this as a measure, and we need to work out what the purpose of superannuation is, or what the objective of superannuation is. And this is really all about how they formulate policy around superannuation. So it's not something that replaces the sole purpose test. So SMSF trustees or whatever still have a sole purpose test, which is what they need to do, what they need to undertake to ensure that they're complying from a SIS point of view. This is more about how the government formulate what super's for, how do we address and identify the various policies that we need to operate under to make sure we're meeting the requirements of whatever we determine superannuation is for. Now, in theory, the government did plan to release some legislation in the first half of the year. In practice, it's the middle of May, it's nearly the end of May, so we're running short on time for that first half of the year time frame, but we've still got a little bit of time where we might actually see something. So we'll wait and see what the outcome is on that. But it ultimately determined that without an objective, it's very difficult for the government to make any announcements in the federal budget. So I kind of look at this and I go, well, does this mean that we're going to have like a mini superannuation budget once we do have an objective? Maybe we will. We'll touch on a little bit of that later. So this objective of super, it did receive broad support across all industries. So everyone's on board with the idea of having a reason to have superannuation. And if we look at the objective, as the government have stated, is to preserve savings to deliver income for a dignified retirement alongside government support in an equitable and sustainable way. And then they've tried to define things like what preserve savings means, restrict access to super savings for persons retirement only. So this is a key measure after COVID-19, where obviously superannuation was rated as part of that compassionate grounds early release. And the government are basically saying, we shouldn't have those sorts of measures. That's not what the purpose of superannuation is for. But then we look at a number of other measures around compassionate grounds, elective surgery and other things like that, and say, is that why we have super? Is super there for first home savers, for buying your first home? And so the current government are obviously going down a path where they're trying to move away from some of those quirky conditions of release to give us access to superannuation money. Talking about income, and so the key thing about delivering income, and when you actually work through the machinations of the government's announcement and the consultation process, this is really reaffirming what the sole purpose test is about. So as I said, it's different to the sole purpose test, but there's a link, and that is that super's there to provide benefits to the members, right? Not to provide tax concessions necessarily, right? And not to provide a savings vehicle for estate planning purposes. So that's something that they've really highlighted. So that, of course, leads to lots of speculation about certain things such as recontribution strategies and other things where people are looking to minimise tax. Well, will we see some sort of movement? Who knows, is the answer to that sort of stuff. So other things, that it's dignified, giving people the capacity to retire in a dignified way, and that it's equitable and sustainable. And so again, this is where issues like the $3 million threshold come into it. Say it doesn't have to be equal for everybody. Super doesn't have to be equal for everybody, but those who are comparative to each other, it should be fair and reasonable amongst them. And then the sustainability element is where measures like the $3 million cap come in. So this legislative requirement is going to dictate what we see in the future from a superannuation point of view. So for me, when I identify some key issues, and we'll come back to it at the end of the presentation, but things like preservation and the various conditions of release, to me, they're the areas that the government will target in potential policy changes. But yeah, we won't see anything until we get this legislation. So let's move on to the budget now. As a client manager, Jenna, you obviously get, I know you get lots of phone calls. I used to work not all that far away from you from a desk point of view. What would be the major calls you've been getting with regards to since the federal budget was announced?
Yeah, certainly, Tim. So the main concern is that $3 million threshold. I get a lot of husband and wife super funds. They ring up concerned because their super fund has over $3 million in it, and they think that they're affected. So as soon as I tell them it's on an individual level, then they're pretty happy about that.
Yeah, and look, and that's it's a good thing. Well, it's a good question to ask. And when we were discussing and preparing for today's webinar, we touched on this a little bit as a measure and said that it is individual based. And so it is certainly the first measure that we want to talk about from a budget point of view. And I guess and because we know we can't give advice specifically, but we can give the facts, and the facts are that we don't have law yet, but we need to make people mindful of that. Yes, this is an individual based liability, so it's a little bit like the old superannuation surcharge, which was all based on your own income, and then yes, you might pay out the liability via superannuation, and it might be driven by money in super, but it is an individual liability. So yes, our balances, if we're both under $3 million, won't be impacted. However, inevitably somebody's going to die, right? You know, without bringing the mood down to the webinar, but somebody's going to pass away, and then it's that next piece of what do we do with our superannuation balance at that point in time if we retain it in super. So if we've both got $1.8 million and somebody passes away, do we then have 3.6 million, which is then going to trigger us into this this scenario and end up with a tax liability? And so what I'm going to address now is, I guess, how that is going to work, and what it actually might mean for those clients, knowing and appreciating that not everything's been finalised. But what we do know is that it's proposed to start from the 25-26 year, which is the government's sneaky way of living up to their election promise of no changes to superannuation. It's like, well, okay, let's wait until the end of the first election cycle, and then in the next cycle, if you choose to re-elect us, right, this will be the measure that you will effectively kick off that new cycle with, or in their assumption, it will already been legislated by then. And so by the time what would be that next government cycle, that's when the measure would kick in. An additional 15% tax on the earnings, right, which is then based on your total superannuation balance. So there's a few issues within that, and I'll touch on those as we go through. The tax is only going to apply to the proportion of earnings above $3 million. So that they complicate things in that that's okay, we need to firstly work out what are your earnings, and then what proportion of those earnings is actually attributable to the fact that you've got more than $3 million, and then you're going to pay tax on that as well. Whether or not or how defined benefit interests are going to be taxed or included from a calculation point of view is something that's obviously front of mind, not just in the SMSF space because you want equality across the entirety of the industry, but it's front of mind because we still have legacy pensions inside self-managed super funds, and I know that some of the work that you and I have done over our time working together, you know, we've dealt in that legacy pension space. So exactly. Yeah, so it's one of those areas that you know we need to have answers for. Here's the kicker. The government opened the consultation period for this on the 31st of March, and they closed it on the 17th of April. Now, not sure how good everybody's memory is, but that included Easter. So it was one of the shortest consultation periods. And to be fair, it wasn't much of a consultation period for the purpose of consultation. So I sat in a round table with a number of my SMSF colleagues and the SMSF Association and Treasury. And basically, Treasury started the conversation by saying the following things are non-negotiable, and that was the $3 million cap and the way that earnings are calculated. And it's like, well, then why are we having a roundtable conversation if all the things that we want to talk to you about are not negotiable? And they said, well, everything can be addressed and presented back to the government, but we feel that they're not going to make any changes on these areas. And so, you know, there's some elements of this that we absolutely need to be mindful of. As to how it's going to work, because it's going to impact largely self-managed superannuation funds more than anybody else. So let's have a look at how it's going to work. It's basically a 3 calculation process. Now, in theory, we're not doing any of that calculation. So in theory, all we're doing is prepping the financial statements like we normally would, and reporting to the regulator. So again, ensuring that our reporting numbers are correct is going to be of huge benefit there. And then the ATO are going to do these calculations once they've collected all of the members' total super balances from various funds that they might have. But the earnings is going to be basically a formula which is the total superannuation balance for the current financial year. So this is done after the 30th of June. Add withdrawals, right? And we'll talk a little bit about withdrawals in a moment. Subtract net contributions, and then take away the total super balance from the previous financial year. So that is the first calculation that we do. Now, a couple of things to note. If the previous financial year and the current financial year total super balance is less than 3 million, no calculation. All right, so pretty simple there. If only the prior financial year total super is less than 3 million, then we replace the actual amount with the 3 million. And if the current financial year total super balance plus withdrawals less net contributions is less than 3 million, then we'll replace it with 3 million. So there's all these variables that come into the calculation that we're going to have to be able to explain to trustees along the way. So once we've worked out what that earnings is, and I'll go through an example in a moment, we then have to work out the proportion of those earnings which are attributable to the amount above $3 million. So it's a mouthful to try and explain all these sorts of things to our clients. And that is the total super balance of the current financial year less 3 million, which is our threshold, divided by the total super balance. And then our tax liability is 15% times the earnings calculated in number 1 times the proportion calculated in number 2. When our total super balance is reduced in the year, so when we've got negative earnings as such, then we can carry forward that amount. So here's the first kicker from Treasury is once you die, so do those carry forward amounts. So even though your pensions might go to your spouse, and your spouse will then have an increase in total superannuation balance, the losses that you generate will not go to the spouse. So there's the first sort of, I guess, legislative kick that we hit with regards to our estate planning from a retirement income point of view. So, you know, we often talk about the pros and cons of reversionary pensions versus non-reversionary pensions. Where this sits in that is going to be a difficult one, because obviously we don't know the final details of the measure. But again, you know, the questions that you're getting have been that about the combination or the number of balances. So would you say, you know, and you can ultimately make this number up, it doesn't really matter, but would you say that you have more funds that represent combined $3 million than you do have with individuals over that $3 million?
Yeah, I'd say so, yeah.
Yeah. So, and I suspect that that's reasonably normal. Like, I suspect that that's probably more commonplace, and will be more commonplace with the fact that we're now in a world where we have contribution caps and other things that restrict how much people put in, which of course is another thing that goes against the grain of why we've even got this measure, is that, you know, we've got caps in place to restrict how much money we can put into the superannuation environment in the first place. But again, going back to that first question that you've been asked the most, this is a personal, not a super fund liability. So it's not based on the combined value or combined earnings of the fund. It's based on each individual member of the fund and what their earnings are attributable based on that calculation. So they can pay it personally, or they can release their money from super to determine what the liability is. So yeah, this is just a bit of a guide as to the whole idea of if someone's below or above the threshold, that there are various calculations that get undertaken, as I said, to bring that threshold back up. And really what that whole ceiling / floor scenario is about is ensuring that if your balance was below that $3 million, then you're not calculating earnings based on those formulas that would give you more earnings than you otherwise have, or give you a higher proportion of earnings. So creating that level there at $3 million does bring some equality, for want of a better term, into the way that the calculation is going to be performed. So let's have a look at an example straight out of the consultation paper. And so, you know, what happened was the government announced this in Feb because it hit the media, and then they released a fact sheet, and that fact sheet was relatively terrible in the sense that it was riddled with calculation errors and not enough information. But then it was followed by the consultation process, which broadened a lot of the examples and rectified most of the calculation errors that were in the original fact sheet, but it didn't give you enough examples. So typically what we see with these measures is the examples that all of us get, right, and all of our clients get, are never the examples that they have in these details. So Carlos here is 69, he's got his 10 million and he started with 9 million. You know, they're the obvious ones, but that applies to maybe, you know, a handful of self-managed superannuation funds. Most self-managed super funds that we know, and the government's calculations too, they said I think this would impact about 80,000 people, I think was the number. But are they forecasting that as to what number it will be in 25-26, or is that based on member balances right now? They've sort of said it's forecast based on when the measure comes in, but I don't think they're looking at the question that you've already raised, Jenna, which is the combination of balances. So I think that number that it's going to impact will be a lot higher than the number that the government actually think, and I think that's something that we need to be mindful of. So with Carlos, 69 retired, his total super balance 30 June 25, 9 million, grows to 10 million at 30 June 2026, draws 150,000 during the year and makes no contributions to the fund. So therefore his earnings, we calculate the earnings, which ends up being 1.15 million, as 10 million plus $150,000, which is the withdrawal value, less 9 million being the opening balance. The proportion of the earnings is going to be the 10 million. So his closing balance less the $3 million floor divided by the 10 million means the proportion of his earnings that are representative of the amount above 3 million is 70%. So his tax liability for 25-26 year is going to be 15% times 1.15 million times the 70% proportion gives him a tax liability of $120,000. Now that's pretty significant, right? It's a significant tax liability that they're going to be hit with. Now, if they've got the money outside, how many people are going to have that sort of cash flow sitting on the outside? Unknown. What about the superannuation fund? Now, there was a little bit of a dig, and you could argue that this dig is a dig at self-managed super funds in the consultation process and paper about investment strategies. And that is that a self-managed super fund must have an investment strategy, and the self-managed super fund must, as part of that strategy, consider liquidity and the ability to discharge liabilities as they fall due. So again, when we're talking about funds that are in potentially large, lumpy property-based assets, there's already fear that because they are almost cash poor and asset rich, that this is going to be problematic for those funds. And one of the key issues, and again, I know we were talking about this yesterday, is we're talking about an earnings calculation on unrealized capital gains.
Yes.
and so it doesn't take much. There might be some property acquisitions. There might be a big development going on in the area where the properties are invested, so the value of the market goes up, and you've got these unrealized gains that now are subsequently going to be brought into the calculation from an earnings point of view, and you are going to pay up to a 15% tax on that capital gain, on that unrealized capital gain.
Yeah.
And then, there's another point in time where you're actually going to realize that gain. And when you realize that gain, the fund is going to be paying tax on that realized gain. So individually, you're paying a tax on unrealized gain, and then the fund will pay tax on the realized gain, whilst you're still probably in that year also going to be hit with an earnings-based tax as well. And so I think, I can't remember, but I think you do have some questions around the concept around capital gains tax as to whether or not people should be looking to reset their bases.
Exactly, yeah. I had a call the other day. There was a client that had an investment that he'd sold down a portion of it.
Yep.
And then, he wanted to maximise capital gains on the portion he's selling now, just so he can reduce potential capital gain, unrealised gains going forward if this measure does.
And that's a really hard one because, unlike super reform where we're losing the ECPI on the amounts above the 1.6 million back then, and so we had this opportunity to crystallise our gains to effectively either defer them or to wipe them out prior to 1 July 2017. Again, the consultation process has really highlighted that because this is not a fund tax liability, CGT is not even a consideration of the government.
Yeah.
So this is it. So it's going to be a matter that it's a real risky strategy for clients to contemplate selling down investments now, or resetting cost base now, because one, they don't know when they, eventually will look to get out of the investment, but two, they don't know where the market's going to go with the investment. And if the market does drop, and if the valuations drop, then all of a sudden our earnings losses could actually be beneficial. And so it's a difficult one, but probably one of the main areas or main pain points from an industry point of view has been this unrealised gain element. And if I take a moment here to sort of touch on the key issue from the round table conversation that we had with Treasury, and this concept that earnings will be based on this total superannuation balance. I guess the main fact or main point that I want to raise out of there is that the self-managed super fund industry are not disputing that this is one way to be able to calculate it. However, we're saying, well, if you have the capacity to provide the actual earnings amount, then why don't you have the capacity to utilise the actual earnings to determine the liability? Because we know that for self-managed superannuation funds, it's not too difficult to be able to flip the switch and show actual earnings per member as part of the actual return from the annual return point of view, get that out properly. So, what we're saying is that there shouldn't be a restriction on actually how you calculate it if you can get to a correct number. Now, Treasury's response to that was very much the government want a simplified approach that is applicable across the entire industry so that there is no more favourable treatment to one part of the sector over another. Now, I'll get you to hold that thought because we're going to talk about another measure in a moment and work out, well, why do we have one policy for one thing and a different policy for another? So if we look at the carried forward of earnings losses, again, this example here, just to be able to spell it out for people or show people there, you've got David who's 70, doesn't matter where his super is, but he had 7 million at 30 June 2025. He withdrew 400,000 from the super fund and makes no contributions. His total super balance is reduced down to 6 million. So what we do in that sort of situation is we go and we add the $400,000 back in, meaning we've got a $600,000 loss. We then do our proportioning calculation, how much of our earnings above the $3 million do we have there? It's 50%. So then the earnings loss on his excess balance is 50% of the 600,000, gives him that $300,000. We then take that on to the next year, and in the next year when his total super balance increases, and then we've also got more withdrawals there. You do your normal earnings calculation. So in this instance, you've got your 6.5 million plus your 150, take off your 6 million closing balance there. Gives us the requirement that reduces the earnings down to or earnings of 650. We subtract the 300,000, giving us the 350 net earnings. We then do our proportion. We note it now that the proportion has jumped from 50% to 53. And then we apply our tax liability there. So there's a lot of ramifications, but having those losses, as I said, relatively beneficial, except, as I stated, they die right with you. So on death, your losses will also die. So let me talk through a couple of the consultation-based commentary, just so people are aware of some of the areas, because what the government have said is that, or what Treasury have said is that they will be releasing legislation on this in the early part of the next financial year. So assume sometime after July we'll see some legislation on this, and they have said that there will be consultation period associated with the drafting of legislation. It would have been nicer to have a much, given that they all they did in the budget was provide us with the same information that we'd already had. It would have been nicer to have a longer consultation period to potentially get those measures extrapolated more beneficially as part of any super announcement. So, there wasn't really, to me, any need to release anything further in the budget there, but that's the way they've gone about it. But some of the key issues that we need to be mindful of, this whole concept of withdrawals and contributions. Right? So contributions, you notice they talk about net contributions there. Well, that's because most people that are more than $3 million can't make non-concessional contributions. So we're talking about our concessional contributions. However, contributions will also include downsizer. It will also include CGT amounts, and then there'll also be amounts like foreign transfers. And then you start to get a little bit sort of, I want to say inconvenient, but that's because the only word that's popping into my mind just at the moment, the inconvenient contributions. So family law splits. Right? So in a family law split situation, and this created some interesting conversation around the table. But in the instance of a family law split, the member spouse, so the person whose interest is being split, that will be a withdrawal. Right? So they will have to add that amount back to their total superannuation balance for calculating the earnings. The non-member spouse, so the person who receives the money, that will be a contribution, so they will subtract it off. So in year one of a family law split, the spouse who has transferred their money to their other spouse will potentially get an earnings tax liability calculation and have to pay that amount, and the non-member spouse won't have that liability. Now, timing is everything with all these sorts of things, but if you undertake in any instance a withdrawal at the beginning of the financial year and you put that money elsewhere and its earnings and doing whatever else, well, then you're going to be made liable for that amount, despite it potentially not being in the superannuation environment for 10, 11, 12 months, whatever the number might be. So there's all these inequity elements around that process versus the straight out earnings calculation. And they're the things that we need to be mindful of. But one of the big ones for us as an industry is this idea of insurance proceeds. So insurance proceeds have been classified as a contribution. So they will be subtracted off the member's total superannuation balance to do the earnings calculation. Personal injury payments, so our structured settlement contributions, we know that they're already excluded from the definition of a total superannuation balance. So what this proposed legislation is doing is it's creating further inequity between people who receive disability benefits, lump sums, and it's based on the means in which they receive it. So if you receive a court settlement payment, so effectively a compensation payment, you're not going to be basically included in this measure. Whereas if you get that same payment for the same condition, but from insurance held inside superannuation, then you're going to get that negative or that credit in the first year, but then the next year you're not going to get that. And if you're trying to use that insurance proceeds to pay yourself a disability superannuation pension because you're unable to work in the future, but your level of insurance puts you over that $3 million, you're going to be whacked with this earnings tax. Now, I'm not sure in which world that's a fair and equitable measure or sustainable, or let's just tick off all the points of the objective of superannuation. So it's a bit of an issue, that one there. The legacy pensions, again, and I'm going to come back and touch on these when we finish off the presentation today, but legacy pensions, what we've said is the government need to move on what they're doing with this legacy pension amnesty, because if we don't have an amnesty, if we don't have certainty as to what we can do, how are we going to count these amounts in the members' total superannuation balance? Because these amounts are representative or represented as reserves, right? So most of them, and you know, I know you've got a couple of legacy pensions that we've dealt with. I mean, are they, off the top of your head, are they large in balances, or are they relatively small? If we forget whether they belong to somebody or not, just as a size of the fund, are they significant?
Not super significant. Maybe under $1 million, maybe.
Yeah, under $1 million. Okay, but yeah. So again, the interesting piece of that is if it's under $1 million, and these clients they're probably in their 80s or whatever now. Those ones are under $1 million. How many of them might be over $1 million? Exactly. But then what happens? You know, if they die and it doesn't belong to anyone, who and how is that being allocated? Because are they going to create a mechanism for allocating or proportioning those reserves across the other members of the fund? Now, it's hard to do that while somebody's alive, but all these sorts of intricacies, you know, haven't been factored into anything to do with this calculation. And so we need to have certainty so we can go back to these clients and say, right, you might lose your Centrelink or you might do this. However, if you can get the money out of super, right, or out of this environment where there's uncertainty, then it might be best to take that action. And that's a difficult conversation to have. But again, if you look at the legacy pension amnesty announcement, they were going to say that the reserve amount you could allocate to the member, right, and then there'd be a 15% tax liability. So what are we saying here is, or what are we saying now is, are we saying, well, here's an allocation from reserve, you can pay 15% tax. By the way, that allocation from reserve now puts you over $3 million, so you can pay another 15% tax. So all of a sudden we've gone from a reserve, which by the way is not exempt income, so it's already paying tax as it goes along, could be being taxed up to 45%. these are issues that I think the government needs to be mindful of. Limited recourse borrowing arrangements, there's certainly issues associated with that as well. So there's all these quirky elements. So with the death benefit piece, as I said, you don't get to carry forward the losses based on the consultation. The reversionary pension will get the credit, and the deceased, well, what Treasury have said is that this tax will not follow you through death. So if you die before the 30th of June, right, then your money's not paid out. So if you haven't paid the benefit out, then no new liability will be raised. But if you've died after 30 June and the liability's already been calculated, then there's a liability. So yeah, so timing, and again, I'm not suggesting that timing of death is important in the situation here. What I'm really highlighting is that people need to be aware as to the ramifications because of the timing of the death of the member. So that leads us to the second piece. And as I said before, I was highlighting that Treasury said they didn't want to have different rules for different funds. So they didn't want to distinguish between APRA and self-managed superannuation funds. And so they just wanted to have one calculation fits all. Yet we have NALI provisions. So I'm not sure, Jenna, how many questions you get about NALI. And look, I wouldn't suspect that it's heaps, but you know, I know from dealing with all the client managers here that there's always questions of, do we have to pay for that? Do we have to pay that? Is it still a common question that you're getting as a client manager?
I did have one recently, actually. We prepared the annual return for one of our advisors, and they hadn't paid any accounting fees whatsoever for their super fund. So that's for the 22 financial year.
Okay, so they didn't pay any fees. Now, of course, you know, we're not here to name anybody as to why they didn't pay it, but the question comes about under these NALI provisions is, why didn't they pay those fees? Why didn't they pay? Why did they not have any accounting fees? Now, of course, they would have administration fees that they would pay to SuperGuardian in that instance for the lodgement of the return. But there are other accounting fees that they've clearly accumulated in that time that they haven't paid. Now, this comes back to this whole concept of why these non-arm's length expenditure measures were introduced in the first place. And I highlight, and I often do this, you know this, that I often highlight my own fund and my own sort of set of circumstances. And the concept of, you know, are you undertaking the work in your individual capacity or in your trustee capacity? Now, I don't lodge, but I prepare my own fund financials, and then my tax agent lodges them. And of course, I get them audited by an independent auditor, and I pay for the lodgement, and I pay for the audit, and I pay arm's length amounts for that. But there is no admin cost. Right, so I basically pay for the software, and that's it. There's no other cost. Now, I'm doing that in my trustee capacity because I do know a little bit about self-managed superannuation funds. So what's not to suggest that this client doesn't have the skill set to be able to undertake that work in their own capacity as trustee of the fund rather than any individual capacity. But who questioned this with you?
The auditor actually came back to us. Obviously, we noted it before it went, but yeah, it was the auditors that came back to us. Yeah,
and I think this is the really interesting thing about the consultation, and I'll start to go through the measure in a moment. But the whole thing about non-arm's length income is that it's not specifically an audit issue. However, auditors have to be comfortable that the financial statements represent, you know, a fair and reasonable financial position for the fund. I'm not using the exact words there, so so don't anybody quote me back as saying that I've misquoted the auditor's obligations. But the auditor has to recognise as part of their reporting that the financial position is fair and reasonably stated. Now, of course, that then implies that they have to have comfort that the fund isn't dealing on a NALI basis, because let's be honest, very few, if any, self-managed super fund is ever going to put their hand up and say, we think we're dealing in a non-arm's length nature here, and we want to be taxed at 45%, right? So most people will think that their transaction is arm's length until they're told otherwise, right? There are obvious ones and where it might be, say, trust distributions, where you can see that the distributions come from a discretionary trust, then you can highlight that as non-arm's length income and identify it. But when we're talking about the arm's length nature of a transaction, we have to go through the whole concept of, is it individual capacity that this work has been performed and not paid for, or is it trustee capacity? And then do we have additional breaches like 17B, the trustee remuneration thing? So there's a whole heap of areas that we need to be mindful of, which is always going to open a can of worms in this place. So we know that well, basically, this legislation came in effective the 1st of July 2018, right? The changes of the non-arm's length expenditure. We then saw the LCR 2021 finalised after 2 years, which basically had this concept around anything that relates to a specific fund asset, then that income will be deemed as gnarly, and only the income on that asset. That most people have great comfort in that. Still have problems with it, but I have great comfort in what it means, right? But it was this whole general fund expense element where if there was a general fund expense that wasn't dealt with on an arm's length basis, and accounting fees, administration fees, discounts, all those sorts of things, that's the primary scenario there, then that's attributable to all, or that impacts all fund, all income of the fund, meaning that all income of the fund would be taxed at gnarly. And everyone said, well, that's really not comparative. Like the fact that someone doesn't pay a few $100s or a few $1,000s and they earn a few $100,000, then that small amount really shouldn't impact it. So, we know that the Commissioner has not been allocating compliance resources under the PCG, but what we needed to know was, okay, well, is there a better way? And through the consultation period that occurred in January, our industry went back and sort of said, yep, there is a better way, get rid of the rule, right? Go back to the pre-2018 rules, because, we feel that it's not actually relevant, and the matter's been addressed, because this did come about from limited recourse borrowing arrangements, so the matter's been addressed through other measures. In the consultation, the government came out with this 5 times factor, right? So a factor of saying, let's multiply the actual expense, or what the expense should have been, not what you've paid. Let's multiply that by 5 and then pay tax, or treat that 5 times the amount as the gnarly. Now that came out of nowhere, that calculation. Obviously from a consultation point of view, the industry's gone back and said, no, we don't like that. This is where we've landed. So where we've landed post federal budget, or at the federal budget, is that self-managed super funds will have a factor-based approach, right, which was previously 5%, which will set an upper limit on how much will be treated as non-arm's length income if it's a general expense breach. So again, if it's specific to an asset, so a property investment or whatever, it's only limited to that asset. But if it's a general fund expense, so accounting fees, those sorts of fees, then now what they're saying is that the amount of fund income taxable at gnarly rate would be 2 times the level of the general expenditure breach. So it's 90%, or 2 times 45, it was 225% previously. And that amount is calculated as the difference between the amount that would have been charged as an arm's length expense and the amount that was actually charged. So in the example that you've given, what is required is say, okay, what should they have charged? How long is a piece of string? But of course, it's one of those things where if you're dealing in a commercial space, and I'll go through an example in a moment, if you're dealing in a commercial space, you would know what you charge, right? If you then charge nil, right, then you've got your arm's length expense, and you're going to multiply that by 2. Okay, so where it goes further is where that 2 times breach is greater than all the fund income, then all the fund income will be taxed at 45%. However, there is a carve out, and this is a good carve out. That income excludes our contributions, right? So we have to do this calculation exclusive of our concessional contributions, which is a good thing. The bad thing about this measure, and this is what I was banging on about before, is that rather than try and apply this factor across all superannuation funds, the government have actually provided an even greater benefit to APRA funds by saying that not only will the general expenditure not apply to APRA fund, but the specific expenses also will not apply to APRA funds. So we've now got to a position where in one measure, the better tax concessions are saying, we want to have a simple approach across every part of the sector, whereas for non-arm's length income, we're saying we're not going to apply those rules to APRA funds. We're only going to apply those rules to self-managed superannuation funds, and that I think has got our industry a little riled up, or our sector a little bit riled up, because it's not showing any element of fairness. So let's run through an example quickly, just to sort of show what it means from a numbers point of view. So again, we're using someone's accounting services, which is normally $5,000 provided under an arm's length arrangement. I'd be questioning how much they're charging for their, their brother's charging for their accounting there, but the brother charges $0 for the services. So the SMSF's income, subject to all other expenses, excluding this, is $100,000, which is normally taxed at 15%. So stock standard calculation there, and in that $100,000 we include $15,000 worth of concessional contribution. So all of that would normally be taxed at the normal 15% rate. So under the current rules, so without this proposal, then basically we're saying the total income of the fund would be taxed at gnarly just because we didn't pay that $5,000 expense, giving us a tax rate of $45,000. Pretty significant. We know that that's a problem. Under the proposed amendment, the income tainted would be limited by the market value of that service. So since no fees were charged, right, what we need to do is we need to factor out what that commercial amount is and then multiply it by 2, right? And then that gives us our income that is going to be taxed as gnarly. So in this instance, the trustees would pay 45% on 10,000, which is 5,000 times 2, right? And 15% tax on the remaining $90,000 income. So we work out out of all that income how it would work, which would give us a result of 18,000 in tax from our tax liability point of view. However, and just as a comparative, under an arm's length arrangement, so if the fund was to pay their $5,000, then the tax liability of the fund would be 14,000, just over 14,000, which is 95,000, which is 100,000 less the 5 if they paid the expense, times our 15%. So the win, if you can call it a win, is that the gap now between that 14,250 and what was 45,000 has narrowed significantly, and we're only paying the $18,000 tax there. But just to take it one step further, the proposal is that you pay 45% on all the fund income, excluding the contributions, but you have to work out what's more, the income or 2 times the breach, and then you pay it on the lesser. So this calculation, if you can all bear with the workings of this calculation, if we say the 5 times 2%, the 5,000 times 2 times 45% is our $4,500 tax. That's how we would do the calculation in the first instance. If our income was only $20,000, right, including the $15,000 concessional, then our actual gnarly income subject to tax is only $5,000, right? And we multiply that by 45%, gives us a tax liability of $250. So where you have again an asset-rich, income-poor fund, and therefore there's not as much income being generated, then this formula might actually result in a slightly lower tax rate to apply to the fund. So there is going to be that calculation that is needed to be done at that point in time. So again, to reiterate what I've clearly already said, total inequity between APRA and self-managed superannuation fund, which goes against the grain of the objective of super and this $3 million better tax concession environment where they're trying to say, let's keep it simple across everything. Here, we've got a measure exclusively for self-managed superannuation funds. For me, and for those that I talk to within this industry, are we chasing shadows? This whole thing was brought about back from non-arm's length limited recourse borrowing arrangements where people had 0% interest loans, and no LVRs to worry about and no repayment terms and things. That was all fixed through PCG 2016-5, and if it wasn't fixed, then it went a long way towards being fixed in that situation. But also a lot of the scenarios that have been brought up through the LCR and TRAIN, which is the I think the plumber who does some plumbing work on the kitchen versus total renovation. All of these measures have been addressed previously in tax ruling 2010-1, what is a contribution, SMSF ruling 2010-1, acquiring assets versus services from a related party. All of these measures have previously been addressed, and I felt that the industry had adequately dealt with them. But to me, this non-arm's length issue is going to continue on and be a problem. But whose problem? That's going to be the issue. And I think the SMSF Association, one of their proposals was actually quite a good one, and that was, well, why don't we incorporate this, or why don't we expand the existing SIS requirements under 109, the arm's length requirements, which would then put the onus back onto the auditors, and maybe the auditors that you were dealing with, Jenna, sort of have already contemplated that sort of proposal and said, okay, well, this is our issue to expose, to be able to have it addressed up front and potentially rectified. But if you make it a SIS issue rather than a tax issue, then you can potentially get away with education directions and admin penalties, and potentially keep the tax lower. So look, it's one of those areas that I think we need to keep our eye on, because without putting you on the spot here, but as an administrator, there would be many people that work for SuperGuardian that have their own self-managed superannuation fund, and I have no doubt that SuperGuardian have a pricing policy as to what sort of discount they apply. Well, what I would say to not only SuperGuardian but everybody who's attending today's webinar is, if you've got staff that are doing their own self-managed superannuation fund, that PCG 2020/5 runs out on the 30th of June this year. So you really must be addressing your policies now and looking at your discounts, and there's nothing wrong with providing discounts as long as it's consistent across all employees. And so that's it's a question I know that I've been speaking about internally here for the last 3 years. Is you don't need to do anything just yet, but now that just yet is coming to an end, and we need to make sure that people are doing the right thing there. So just on a couple of other budget issues, because I said they were the two primary ones. Obviously, what wasn't announced in the budget was any further extension of the temporary pension minimum reduction. So that becomes an issue from the 1st of July 2023, that we need to take ourselves back to our standard minimum pensions. And of course, that becomes not only a budget announcement here, or it becomes a tax planning issue from 1 July, because will everybody be paying still have a periodical payment set up for their half minimums versus full minimums, and you don't want to get to a compliance issue in 15 months time, or whatever the time is now with regards to paying their minimum there. A couple of other issues: payday super, which again, we've got a future commencement date to allow systems to be upgraded, but the idea that Super Guarantee is paid with your at the same time as you pay. Right now, for me, I think this is I'm not an employer, so I can say this. I think it's a great measure in the sense that, from a planning point of view, it gives you greater certainty around things such as the ability to make personal deductible contributions, because if you know what's going in on your payday, you know when that money is hitting the account, you know if it's pre-30 June. Whereas with the quarterly requirement, then you're factoring in that any contribution made in July is actually based on the previous year's salary and things like that. So I actually think that's a really good measure. And then the other one, which is linked, I guess, to the fact that there has been no other measures, and we were happy to not have any sort of announcement made about it, and that is the general transfer balance cap. So we know that will be increasing to $1.9 million from the 1st of July 2023, and that will have impact on things such as your ability to make non-concessional contributions. So I want to talk about some other measures that haven't been touched on. I started to talk on these previously, but I think these two issues are relatively significant, because the first one, sort of SMSF residency. Did you come across from an admin point of view a number of funds where you've got members overseas?
A very small handful.
Yep. So
they're still there.
Yeah, they're still there, and from a process point of view, it's an interesting one, because you've got to deal with the trusteeship. So you have to work out, how many people are overseas, right? So whether the whole family's overseas or half a family's overseas. You have to work out who the decision makers are in the fund. So you've got this central management and control element that you need to be mindful of. But then you've got the real sort of fly in the ointment part of this, and that is the active member test. And currently, if you are contributing whilst overseas, then you trigger the active member test calculation that requires the fund to have at least 50% of all active member balances belong to resident active members. So if you've got 2 members in your fund and you've got 1 member overseas and they contribute and a member in Australia doesn't, then you'll fail that test every single time. If you've got both members contributing, then the person that's resident in Australia has to have at least 50% of the assets of the fund. So the government, and this goes back to the 2021 federal budget, the government announced that they were going to remove the active member test and they were going to expand the central management and control safe harbour from 2 years to 5 years. We then had a change in government, and the last thing we got on this was an announcement from the current government in their October budget last year that said they are still going to proceed with this change. However, it will not come into effect until the 1 July following the receipt of royal assent. Also, once the legislation receives royal assent. Now, the issue with that is that, again, it's May. So if we don't see any legislation on that now, and let's assume we're not going to see it before 30th of June, and it's certainly not going to be passed, then this measure is unlikely to come in until at the very earliest 1 July 2024. So it means we've got another 12 months of having to deal with compliance or potential compliance issues of people wanting to contribute to their super fund whilst they're overseas, people who want to move overseas and still have a fund, and then you've got the whole do we need to appoint enduring powers of attorney and trusteeship issues to be conscious of. So that measure for what, and I know and I appreciate that residency is a much broader issue, tax residency is a much broader issue from a government point of view, but the SMSF definition just seems on face value to be a very simple change, right? Remove one sentence and change the number 2 to the number 5 in the legislation. So I'm not sure why this is all being held up, because it received universal support. But there was no naysayers about this piece of legislation. So to me, it's one of those things. Why can't we just move forward and get on with it? The legacy pension conversion, as I said, this really now is contingent on how this $3 million threshold moves forward, because we can't move forward with the legacy pension, with the $3 million threshold, whilst we still have these legacy pensions in self-managed super fund, without certainty as to whether or not we can actually change these pensions and revert back to account-based pensions and take the money, or potentially take the money out of super. So there's a bit that we need to get further information on that we haven't actually got anywhere on, and we need consultation with the industry, because I can guarantee Treasury don't have enough information about these legacy pensions, and you'll need those people with the experience within the SMSF space to deal in this scenario. As I wanted to come back with and finish off on this objective of super elements, again, as I said, I suspect we'll see a mini super budget, maybe. So therefore, you don't quote me on that, anyone as an attendee. Once we do have an objective of super, and it may look at things like early release, so early access under compassionate grounds for things like elective surgeries. It might look at things like the First Home Super Saver scheme. It might then look at what the government are going to determine is a major item versus a minor item, as to whether they change or make changes in this current government cycle, or whether they wait to post the next sort of government cycle. What does it mean for things like recontribution strategies? There's already been commentary made about whether recontribution strategies are actually a viable strategy under the future of the objective of superannuation. And so for me, I don't see the harm in them from a taxation point of view. But what these sorts of measures will do will kickstart a lot of discussions as to whether people are going to leave money in super or take money out of super, which then puts a greater emphasis on ensuring that administrators, are getting the information they need to be able to accurately report to their clients. So just to finish off with, we've got our rates and thresholds. So a couple of the obvious rates there, the low rate cap, the ETP cap have gone up. The general transfer balance cap going to $1.9 million, probably the most significant. But more significant is that the concessional contributions don't change. So most of us know this by now, but it's significant because it means that our non-concessional amounts don't change. So whilst our thresholds for making or using the bring forward go up, so the 1.9, the 1.7, those numbers there, the amount we can actually contribute doesn't go up. But the positive is that we've got the $1.9 million, so that provides a lot of planning opportunities around that build into 30 June and then following 30 June as well. So as our takeaway, we do need to wait on further details on legislation based on these budget measures, so we can speculate and we can be aggrieved about things, but we need to wait and then go hard on any consultation at that point in time. But we also need to, as I said before, and I said it to yourself, Jenna, and I said it to everyone in attendance there, you need to look at the issues associated with PCG 2020/5. And if you're currently dealing in an environment that might be deemed to be non-arm's length, then you need to use the next month and a bit to review that so that you've got everything moving forward from appropriately from 1 July, and particularly your minimum pensions that we take them back to the original pension threshold. So look, that's it. There's a bit of a fast run through of some of those changes. I'm not sure, Jenna, did you have any further questions for me about any of it, or any things that you might want to raise from questions that you've had from clients, or we've covered off on them?
Yeah, I think you've covered off really well. Thank you so much, Tim.
No worries. And what about anyone from the any of the attendees? If there's any questions, put them in the chat box. Otherwise, in the Q&A box. Otherwise, we will call it a day and look forward to seeing you next month, where we do a bit of a 30 June sort of tax planning webinar as to contemplate all the things that we need to talk about as we approach 30 June. So look, thank you all for attending, and we'll look forward to seeing you next month. And thanks again, Jenna.
Thanks so much, Tim.